Medical, healthcare and other associated inflation is one thing, but what about CPI inflation? What about the basket? CPI inflation for April came in at 5.9% year on year. They were expecting 5.8%. Previous month was 5.9%. Where's the inflation? We're still below 6%. What about the rand? It's gone from 8 to 9.50 in a matter of around about 9 or 10 months. In the studio with me now is the chief economist at Stellenbosch Economists, and that is Cobus Nel. Cobus, it's not taking off really, is it?
No, but it wasn't expected to take off, really. The direction is a bit firmer than was expected. I think the real underlying causes were still transport and food. The weakness of the rand, typically the transmission is several months, so I think the pressure will continue to build in that. There were specific monthly issues this time around. The fuel levy and the increase to the road accident fund certainly came into play. I think the real danger at the moment is what's going to happen to wages this year going forward. So considering tomorrow's MPC decision, I think it's probably a wait and see approach more than anything
They've
else.
got to be forward looking. I mean, what you've just said is absolutely right with the wages situation. I mean, there's this posturing between AMCU and NUM, and I don't want to single out those two unions, and I don't want to say that is the major influence on inflation, because I think it's the South African rand. But on the other hand, if some people are saying, well, we'll sign you up as a member because we're going to ask for 60%, that's very, very dangerous.
Yeah, it's a dangerous sign. It's also a question of the precedent that has been set previously. I agree with you, the bank certainly won't be looking at that at the moment, but certainly it would be in the back of their heads. Our real interest rates when looking at the repo rate are slightly negative at the moment, given where inflation is. Core inflation is still ticking up slightly, which limits their capacity for further easing significantly. Any further risks of easing would be symbolic by nature. It wouldn't have much of an effect anyway.
I was thinking yesterday, and looking at all the different things, I put on the left-hand side the yes for an interest rate cut, on the right-hand side the no, and I thought to myself, perhaps the popular decision would be for a 0.25% cut, and that would be the last one for quite a while. But when you see this, the differential between the repo and the CPI inflation rate remaining at 0.9%, you've got to surely raise rates in order to get positive real interest rates.
Yeah, but again, they're forward-looking. So the advantage in this is that while headline and core inflation are still on an upward trajectory, the expectation is that will ease towards the middle of the year. And specifically, if the rand starts tracking back some of its recent weakness, that retraction could be a bit faster than is currently expected. So I think there's very little pressure on the Reserve Bank at the moment to do either. Frankly, I personally think it will be another no event.
I'd love to be a central bank. I'd love to be Ben Bernanke saying, well, I'm going to carry on pumping 80 billion into the market. I'd love to be Jill Marcuston saying, we're doing absolutely nothing. Yeah. Being facetious, of course, very difficult job. But when you look at the 5% that we've got, is it 5%? Yeah, it is 5% we have versus the 5.9% on the CPI. At some point, that has to go positive. There has to be positive real interest rate. When was the last time that you remember that we had such a situation?
Off the top of my head. Well, a situation like this, it was before the previous spike in interest rates. Having said that, I think this time, it's kind of overused, but this time is different. There are significantly other drivers at play. There's the still real fear of longer-term deflationary pressures building into the system. So the pressures for inflation at the moment, and this is now not assuming an upward wage spiral, which could transpire this year, certainly gives the governor enough scope to relax on it, and also the kind of very soft change of focus to core inflation rather than headline inflation, the kind of acceptance that administered price increases, things that are related to the rand, monetary policy has very little impact on that. So I think the governor has a very difficult job in doing nothing in this case, because she's got lots of pressures on all sides, but she can obviously handle it, so I think she won't be swayed at this point.
She's very confident. She's a great governor. But what about administered prices? What about the oil price? They're inelastic. In other words, if electricity costs more, I have to pay it. If petrol price costs more, if I want to drive to work, then I have to pay the extra. That takes money out of my pocket, and therefore actually, in a perverse way, it reduces inflation because it reduces reduces my demand for other goods and services.
And that's specifically why monetary policy has no effective transmission mechanism in that situation. So it's not demand pull at all, given that the external and the administered prices are the real drivers currently, and therefore there's no point in going any further. The problem is the negative consequences of raising or dropping interest rates further, and you get the perverse incentives into the asset classes, etc., and that's what they're also guarding against.
I've been hearing for years that inflation is going to take off worldwide. I've heard people like Jim Rogers sitting in Singapore and saying, well, commodity prices doing this and the dollar doing that, and inflation is going to take off. It hasn't in the United States, it hasn't in Europe, and it's not in South Africa, although we're just below that 6% level. It's still there. And as I've said, I was looking at the graph now, 8.10 in August of last year, the dollar rand, now 9.52. Where is inflation? It's certainly not being driven by the rand.
No, well, inflation in South Africa, there's a structural component to that, which has to do with our own expectations and our the kind of animal spirits aspect of it. The rand impact certainly plays a very large part over time, and the recent rand weakness, I expect to play a significant part going forward.
What's the lag, actually? Sorry to interrupt you, but there must be some formula that you say when the rand goes from 8 till 9 to 8 to 9, it takes 6 to 9 months.
On transport, it's much quicker because the fuel price adjusts very quickly. So we're talking 6-8 weeks. On food, depending on in which part of the cycle you are, it can be anything up to 6 to 9 months, and the contractual cycle obviously in that. The problem in South Africa is that we're still at exceptionally low levels of demand, and capacity utilization is still very low as well in historical terms. So companies are loath to push up prices. We've seen a bit of that on food and beverages starting to come through. There are some better conditions, some better trading conditions out there, and people have been able, but they've also been forced to increase their prices. Specifically this year we have the risk of the 3-year rolling wage agreements that are coming up for renewal, and that's kind of the gorilla in the room that nobody knows how to call. So that is the one that should be worrying us most.
Lack of demand in the economy is actually quite significant when it comes to inflation, of course.
Very.
We talked about administered prices, talked about the oil price, talked about the rand. We can't actually have any control over that. Well, we can over administered prices, but on the other hand, if people haven't got the money in their pocket to go out and buy things, then the prices of goods stay low. I mean, if you look at a chicken producer, for example, they have to keep their prices low because of the competition from imports from overseas. So all these dynamics are keeping inflation, keeping a lid on inflation, I think.
Yes. And I think that's the argument that the Jim Rogers of the world has at the moment still, is that the conditions are not conducive to sharply increased inflation, simply because there is a lack of demand and there's a surplus capacity in the global economy. Over longer terms, firms are intent on maintaining market share during periods of downturn. So they absorb more of the costs, they become leaner and meaner, and once demand starts picking up, then they can start chasing profit again. So it's a natural economic phenomenon that we're seeing at the moment. The question will be in a lot of the strength in the dollar the last couple of days or weeks have been on the speculation that the whole concept of quantitative easing is not coming to an end necessarily, but they're starting to look at ways of withdrawing out of it. There's conflicting signal on that, so we're not entirely sure which way it's going at the moment. But certainly the extraction out of that period of kind of biblical proportion monetary creation will be the telling sign whether we do have inflationary problems down the line or we don't. I think, in all honesty, the central banks have impressed most analysts the last couple of years, and they're dealing with a crisis. And the fact that they're willing to take some very risky and unproven policy measures into effect.
Unproven in the short term, but they knew that the short term would be extremely impactful.
Yeah.
But it's after they've resigned, like I said earlier on. Mr. Bernanke's gone in 2014. He can sit back, kick off his shoes, have a cigar and a glass of whiskey and say, oh dear, look what I did, but he's got to deal with it.
Having said that, but the reality is, the oft-quoted version of in the long run we're all dead. And I think they learned a lot from the Japanese experience in the 90s. there were, I can't remember the governor now, I think it was St. Louis yesterday, who said that frankly we should have done more at the beginning of the crisis. We misread the signs of some forms of activity still increasing in the US economy. So there's a case to be made at the moment that they should have been more aggressive on the quantitative side 3, 4, 5 years ago than they were. The question, of course, is that stickiness in policy. Once it's out there, how do you pull it back? And what will that implication be for a country like South Africa
exactly.
when the asset allocation models start changing and money flows back towards the core?
Nice, easy question for you now, last 30 seconds, Kubus. Okay, here we are, let's call it 6% CPI. Is it going to be 9%, i.e. 50% up for inflation, or 3% and almost deflation, 50% down? So 6 to 9 or 6 to 3 CPI?
When?
In the next 2 years.
My personal view is 5 to 7. If
okay, so slightly higher. You won't get a 9.
Yeah, we might get a 9 depending on the wage spiral, because the wage spiral could impact on our credit ratings. That would impact on the rand. That would further create a negative feedback into the wage cycle, and then we could probably see a 9. We're certainly not there at the moment. It's more a question of we have to guard against that. That's the downside risk. The current trajectory, if that pans out, the kind of dominant view is that we'll comfortably be just above 5 for the next couple of years.